In this example, we'll be continuing with problem 16-1A on page 766 in your textbook. In the previous video, we walked through how to complete the operating activity section for this problem. We will now complete the investing and financing activity sections. Investing activities records any sale or purchase of non-current assets for cash. So things such as intangible assets, investments, and property, plant, and equipment. We always list our inflows before we list our outflows of cash. So if we review the information given, they tell us in letter A of the additional information that our investments were sold for $210,000 in cash. So this is an inflow of cash from an investing activity. So we have cash received from the sale of our investments in total of $210,000. That is the only cash inflow from our investments. We also had some cash outflows. They tell us in part B that equipment and land were acquired for cash. So that means that we paid cash to purchase land and we paid cash for the purchase of equipment. So let's start with the land. If we look at our comparative balance sheet for land, last year on December 31st, 2013, the balance in the land account was $0. This year, it's $246,000, which means that we spent $246,000 on that investing activity. We also paid cash for the purchase of equipment. Again, go to your comparative balance sheet. Last year, our balance was $414,840, and this year, it's $528,840. So if we do the difference between our balance this year and our balance from the prior year, we get how much we have spent in cash for this investing activity. In total, we have spent $114,000 on the purchase of equipment. If we add these three components together, we can see that we actually have a negative $150,000, meaning that we spent more cash on investing activities than we received from our investing activities. That is why you see here that it says net cash flow used for investing activities. We have used some cash to invest in assets such as land and equipment. We can now move on to our financing activities. We finance our business in two ways, through debt and equity. Debt would be the issuing or selling of long-term notes or bonds. Equity transactions would be including the sale of common and preferred stock and issuing dividends. So looking at the information provided, it does not show any long-term debt that was issued or paid off, but it does tell us in Part D that the common stock was issued for cash. Again, we want to put our inflows before our outflows of cash. So we have our cash that we've received from the sale of our common stock. Recall from chapter 13 that when we sell stock, we have to record it at its par value. Any amount we receive above the par value goes into an account called paid in capital in excess of par. So when you receive cash from the sale of common stock, be sure that you're comparing both your common stock accounts from last year and this year and your paid in capital account from last year and this year. So if we look, this year in common stock, we have a balance of $95,000, and last year it was at $75,000. So we have an increase of $20,000 there. And our paid in capital account this year is $290,000, and last year was $210,000. So we have an $80,000 increase there. So overall, we have $100,000 that we've received for the sale of common stock. In Part F, they tell us that there was a $72,000 debit to retained earnings for cash dividends that have been declared. Again, recall from Chapter 13 that there's 3 important dates when we're dealing with cash dividends: the declaration date, the stockholder of record date, and the payment date. So just because the dividends have been declared does not necessarily mean that they've been paid. But this would still result in an outflow of cash for the dividends that we did pay. So if we take a look at our comparative balance sheet, we will see that we had dividends payable last year of $14,400, and this year it's $18,000. So we would assume that the $14,400 that were owed from last year were paid this year. We declared $72,000 in dividends this year, and we've paid all except for the $18,000 that is still in the dividends payable account for this year. Meaning in total, we paid out $68,400 in dividends to our shareholders in 2014. We add these 2 components together to get a positive number of $31,600. Again, notice the difference between your investing and your financing terms. We used more cash than we received in investing activities. That's why we have net cash flow used for investing. However, we received more cash than we spent on financing activities. So we have our net cash flow provided by financing activities. We've now completed our 3 sections. So we have our 3 subtotals: our cash flow provided by financing activities, our cash flow used for investing activities, and our cash from operating activities. So overall, we have an increase in cash of $29,880. We need to add that to the cash that we had at the beginning of our year. So again, go to your comparative balance sheet. A cash balance at the end of one year becomes the cash balance at the beginning of the next. So our cash balance at the end of 2013 of $439,440 would have been our beginning cash value for 2014. If we add together the beginning cash value and our increase in cash during the year, we arrive at $469,320. Notice This is the exact value that you see on your comparative balance sheet for the cash balance as of December 31st, 2014. This always has to match. The statement of cash flows is explaining what happened to our cash, where it was spent, and where we received money over the year.